Welcome to Trading 212's tutorial series on trading strategies. In this second tutorial, we will go over how to trade retracements. Once again, keep in mind that each strategy will take time and practice to master. We suggest you take advantage of the free practice account in the Trading 212 Pro platform to test the strategy with live prices. In this tutorial, you will learn what retracements are, what benefits trading retracements provide, what Fibonacci retracement levels are, and finally, what Fibonacci extension levels are and how you can use them as take-profit levels. What is a retracement? Retracements are short-term price corrections during an overall larger upward or downward movement. These price corrections are temporary price reversals and do not indicate a change in the direction of the larger trend. Finding and trading retracements is a method of technical analysis used for short-term trades. The main benefit of trading retracements is that they provide an opportunity to profit by entering a trade in the original direction of the trend at a better price, just before the continuation of the move. Why do retracements occur? I will illustrate with an example, assuming we are talking about a large upward trend. A significant number of traders start to buy as they believe the market price will increase. This pushes the market higher, and as more traders notice the movement, they start buying as well. When the movement has gained traction, some traders will close their position to take profit, and this may result in a temporary sell-off, and the market will pull back and the upward momentum will be suspended. After this, the original forces that formed the trend resume their activity, and the price continues to rise until the trend has run its course and reverses. So how would you enter your trade in a retracement? What's first? The first thing you need to do is find a strong upward or downward movement of a given financial instrument. To find a good entry position, you should look to enter the market in the direction of the trend right after a pullback has occurred. Put simply, you should buy pullbacks in an uptrend and sell rallies in a downtrend. However, how do we know when the market will pull back? This is where Fibonacci retracements come in. In order to apply Fibonacci retracement levels to your chart, you need to identify the swing high and the swing low points of a trend. A swing high is identified as the highest point displayed on a given time period. A swing low is created when a low is lower than any other point over a given time period. Using the Fibonacci retracement tool in the trading platform, you draw a line between the swing low and the swing high. The horizontal lines that occur are the Fibonacci retracement levels, which are automatically calculated by the trading platform. The most popular Fibonacci retracement levels are the 38.2%, 50%, and 61.8%. In the Trading 212 Pro platform, you have a Fibonacci retracement tool. It places support and resistance levels on your chart based on the Fibonacci numbers. There are many theories, mathematical equations, and strategies out there that try to make sense of a market that is largely speculative. However, it is widely accepted among traders that rely on technical analysis that most major moves will retrace around the Fibonacci levels, and more specifically around the 50% level of the move. So in an uptrend, a price will retrace down a certain percentage of the move before continuing its long upward movement. Likewise, in a downward trend, the price will move up a certain percentage before continuing its long-term downward movement. If the price moves beyond the 50% level, it might be a signal a trend reversal is about to happen, and it may be an opportune moment for switching the direction of your next trade. In this tutorial, we will simply refer to the Fibonacci retracement tool and how to use it. We will be explaining the mathematics and more on Fibonacci in following video tutorials. So traders use these Fibonacci levels as efficient entries in the direction of the trend. Because many traders watch these same levels and place buy, sell, or stop orders based on them, they are quite accurate and become a self-fulfilling prophecy. So how should you enter in an uptrend? You can use the Fibonacci retracement levels for an entry into the market. For an entry in an uptrend, you should look to see whether the price finds support at these levels. Then we suggest you wait for confirmation that the price will move back into the original upward movement and then enter. As with any technical indicator, it is better to seek additional indications to support your initial analysis so that you don't base your trade solely on Fibonacci retracements. Look for clear signals to buy or sell. For instance, wait for a candlestick to close in the desired direction to give you more confirmation on whether you should place an order. If it does form, you can place a market order at this point as you have solid reasons to believe that this level could hold. How to enter in a downtrend. Likewise, for a downward trend, you can place your entry after the price has found resistance at one of the Fibonacci levels. After you wait for confirmation that the price will move back into the original downward trend, you can place your entry order. So how to place your exit? Now that you have decided on your entry, you need to determine your exit strategy. Your exit strategy is comprised of 2 steps. First one is deciding where to place your stop loss, and the second is where to place your target profit. Let's look at the same graph that we had for our upward trend. Here we suggest you place your stop loss just below the retracement level. In a downward trend, we suggest you place your stop loss just above the retracement level. Where should you take profit? And now for the best part, your target profit. If we use Fibonacci retracement levels to forecast entries into the market, we can use Fibonacci extensions as reasonable profit targets. Fibonacci extensions make good potential take-profit levels for trades in the direction of the trend. Similar to the retracement levels, the key Fibonacci extension levels are 38.2%, 50%, 61.8%, as well as 100, 138.2% and 161.8% extension levels. The Fibonacci extensions correspond to the retracement levels, making it all very simple. If you enter at 50 or 61.8%, a good take profit is the corresponding extension level at 161.8%. Let's go to the Trading 212 Pro platform to demonstrate how to use the Fibonacci retracement tool. Here we have opened the chart for the German index Dansk in a candlestick mode at a 1-hour time interval. The price's movement is easily recognizable. In the Trading 212 platform, on the side you have a Fibonacci icon. When you click it, you choose retracements. Then you click right where the trend begins and drag until you reach the end of the movement. Where the move started, you'll see a 100 displayed on the side, and where it ends, a 0. When you have plotted this line, the Fibonacci tool automatically places the retracement levels based on the Fibonacci number sequence. In our case here, you see a retracement at 38.2%, and we would enter at this level. We would then place our stop below the entry level. You could place it either below the 50% or the 61.8% level. We will take the first Fibonacci extension level at 61.8% as a reasonable target profit. To summarize, a retracement is a short-term price correction during an overall long-term upward or downward trend. The benefit to trading retracements is that they provide an opportunity to profit by entering a trade in the original direction of the trend at a better price. The basis of the trading strategy is to buy pullbacks in an uptrend and sell rallies in a downtrend. A good way of identifying them is to use Fibonacci retracements. To set your take profit, you can use the Fibonacci extensions as reasonable profit targets. As always, we recommend you use stop losses. They can be placed above or below the last retracement level. What to watch out for? Each strategy has its risks. When trading retracements, make sure that it is a temporary reversal and not a new move in the opposite direction. This would essentially be a reversal, not a retracement, and would incur a loss for the trader who's placing orders with the original move. We will discuss reversals in our next tutorial on trading strategies. Thank you for watching this tutorial on trading retracements. We wish you successful trading with Trading 212.